Assalamu alaikum everyone, welcome back to another video. I hope you're having a great day. I just want to talk to you guys about today the market, generally the market, and then I'm going to tell you exactly what I'm doing. I'm going to share with you my wish list, or basically watch list if you like, of companies that I want to buy and what I want to do with the portfolio generally, because right now as it seems there's so much news going on, and because I've been at home for the last few days because I've got COVID, but alhamdulillah I'm doing well now. I'm just watching the news and checking out and doing a little bit of research here and there when I get the chance. And what I've realized is the last couple of days the markets are behaving really strange. So there are a couple of companies like Tesla's down now. Yesterday I think was Microsoft was down at some point because of their earnings report and so on. But majority of these companies have actually not reported yet, and they are down quite a bit. And then you've got companies who have not reported but really up a lot. So it's just a very, very strange times. So I just want to share my thoughts and also let you know historically what happened. We will look at some history, and we then will look at my portfolio, and I'm going to tell you the plan just in case of a crash, or what I'm going to do in the next couple of months, because that's really important. That has kind of now basically what's happening now kind of changed my mind in a way. Okay, so I've changed my direction of what I want, the companies that I wanted to invest in and so on. So I just want to share that with you. If you enjoy this kind of content, please just like the video and subscribe to the channel, and yeah, enjoy it. Right, so the first thing we're going to look at is basically this. Okay, what's called trading psychology. So what has happened is there's a couple of things I want to share with you guys, and then I'm going to show you a graph. So normally what tends to happen is you've got like loads of different stages. So according to this guy, it's about 14 different stages, right? So you've got the optimism, excitement, thrill, euphoria. The first four basically is what we went through in 2020. So beginning of 2020, the stock market went down around March time. After that, everyone got into the market, and we've never looked back. It was amazing, right? Everybody was in the green. We were buying all sorts of companies that we've never heard of. There was the spec companies that are just IPO'd and all of that, and everything was perfect. Then we got to 2021, especially end of 2021, right? Because everyone start to worry about what's going to happen, because obviously in the US, if you are looking at the S&P 500, then obviously the US stocks is where you put in a lot of your money. And basically the Fed came up, talked about basically tapering, talked about interest rates, inflations, all of these things start kicking off, and everyone start realizing, oh, it's not as fun as it used to be. So the anxiety, the denial, the fear, all that started. Okay, then you've got depression, then you've got panic. Okay, and then it goes on and on until we get to number 12 here and number 13 here, where you get hope and relief and you get back into the market. So let me show you what it looks like, right? So you've got smart money here, you've got institutional investors, you got the public, which is just us basically. Okay, so you've got smart money, those basically hedge funds and so on. You've got the takeoff here. Okay, so around here is where the market took off. So imagine this being 2020. It went up and up and up, and then around October of 2020 it was kind of down a little bit, and then it went up again. Okay, so the first sell-off, people are like, oh, what's going on here? And then they realize, okay, that's fine. So you kind of get to a little bit of a bear market for a bit, and then we haven't actually had a proper bear market, but that's normally what tends to happen, right? Then the media attention, obviously, then the enthusiasm kicks off, then obviously the greed, people start becoming delusional, and then when you hit a new paradigm. So end of 2020, basically this is where we were. Okay, 2021 started, it was perfect again, it was down a little bit, and then it was up again, and we got to the summer of 2021, and things were not really as good as they were. Okay, by the end of September, October 2021, and then we come down around here, and then we had towards a bull market towards around December time. So then we got returned to the normal. So everyone now thinks everything is perfect, we are okay. Okay, and then all of a sudden January started, and December, January, we kind of going down this way. So right now we're here. Okay, and this is the stage where everyone is selling. Why? Because you're fearful, You're worried about not getting your money. You're worried about making a mistake. You think, okay, you made the worst mistake. You bought companies that are in the ARK investor company, for example. So if you bought the ARK Innovation, for example, year to date, so just the beginning of this year, or even about a year ago, okay, you are down right now 50%. So if you bought it this time last year, January 28th of January last year, so this time last year, you're done about 50%. If you bought the the S&P 500, okay, so beginning of this time last year, you're up about 15%. Obviously, a lot of us cannot invest in the S&P 500 right now because of Sharia compliance situation and the ARK Invest or whatever, but I'm just giving you as an example of where you might be, right? So if you bought these stocks or these ETFs or stocks that in this ETF and you're down 50%, basically this is where we are. You might start panicking and start selling it because you're worried about what's going to happen in the future. Now, if you look at the valuations of the stocks that you bought, and you understood where, what the company does, where they're heading, because remember the stock price, okay, is generally like a forward-looking thing. Because what you're doing is you're looking at the current situation, basically, and predict the future of the business. So you might want to say, okay, the company is making this much profit, this, and that, and then come up with some sort of a fair price that what you're willing to pay in the future. That's what we do, right, as investors, because we kind of saying this is where Tesla will be in about a year from now, and for that reason I'm willing to pay this much, okay? And you obviously have your profit margins and all that stuff. So we got to a stage now where a lot of us probably bought stuff that we didn't know about. We got to here, we were fearful, and then it carries on, and then we became untouchable. And right now we're coming back down here and we're kind of panicking a little bit, okay? And that's normal, okay? But what you cannot do is sell your stock. If you bought it and you genuinely bought this company because of, like, you've done your analysis, you believe in the business and so on, you cannot sell it, right? You're going to have to hold on to it. But I warn you, okay? And I'll show you why. In 2000, okay, the tech bubble, I'm going to share with you two companies. Cisco is the first one. Cisco was supposed to be the first $1 trillion company in 2000, around 2000, right? So this article was written in March 19, 2000. And it says the farmers market climbing to $1 trillion. And they're talking about Cisco Systems. At the time, it was trading $131 per share. They talk about blah, 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 how amazing the company is, how it's a buy, and it should be $1 trillion company. 20 plus years. So they had a split, by the way. When you see the highest price here, that they had a split. So it says it's about $80 per share. Now, if you bought it around that time, so if you bought it in 2000, and you've been holding it to this stock for about over 20 years, right now, you would be down 31%. So it would have taken you, you still wouldn't be able to get your money back. 20 plus years, you're still down 31%. And this is the danger. This is what we're playing with. This is the game we played. Because of the tech bubble, and basically what happened was there were so many new companies, technology companies, that a lot of the banks said they're great, blah, blah, blah. Let's go on the public markets. And all of a sudden they IPO'd, everyone loves them. And they, every single company has something to do with the internet, and the bubble started. And all of a sudden they were on higher valuations. Everyone was buying it. The people were putting a lot of money into it. And then they collapsed. And only a handful of companies actually remain, right? And one of those companies is Cisco and Intel. Intel had a similar situation, okay? So since the time, so it went up to $72 per share. Right now it's trading $48. It never went back to that stage. After 20 plus years, it's still down 33%. So this is the danger. So if you're buying the Zooms, all of these companies that have no earnings yet, and you bought it in the hype, okay, because they were speculative and everyone else was buying it. Sometimes you might have to take your money and run away and cut your costs, because you cannot be waiting over 20 years and it's still be down 30 something percent. I'm not saying you have to sell your stocks, but I'm just giving you the facts and what could happen. So when you buy a stock, you really have to look at things. Look at the PE ratio of this company, right? Look at the market cap. This company has actually gone up in value over the last 20 years, but it still never went back to the price. Okay, price is what you pay, value is what you get. That's what Warren Buffett said. The value of the company is actually gone up. It's amazing business, it's gone up. I know it's been down the last few months, whatever years, but it is actually a great company, $196 billion company. One of the biggest when it comes to chip making, right? But again, if you paid for this sort of price, then you will be down right now after 20 plus years. So there are a lot of hype that has happened before that could potentially still happen. But if there are a handful of companies that you genuinely like and you feel like you are, you've done your research. So if you own, for example, CrowdStrike, or you own Teladoc, or you own Zoom or whatever, and you feel like you will get your money back one day, then hold on to it. But if you just bought it in the hype, then do your research. Find out what these companies are worth right now. Okay, what is the future look like? Okay, don't listen to the basically in CNBC and whatever. Don't listen to the radios and whatever. Just focus on the fundamentals. Look at the business inside out. Once you understand what the business is doing, then you can actually keep on, hold on to that business or sell it and take your money and put it into somewhere else. Okay, right. What am I doing then? So this is what's happening right now. There's so many companies that are down. Okay. And every single day I see a new opportunity and I'm like, oh, should I get that? And then it comes back and the market is basically change again. So it's really strange times to invest, but I still own the same companies that I had before. I'm not selling anything if I still believe the fundamentals of the business. And what I'm doing is I'm adding to the companies that I already own and starting new positions if I get an opportunity. So this is my watch list, okay, that I'm actually put together myself. And these values that you see, so you've got the sector, you've got the PE, and then you've got current price, and then the fair value comes from Morningstar or other companies that I use, okay? I've given myself a margin of safety, so 5 to 15%, and then my ideal entry price is this. So if any of these stocks hit that price tag or even lower, then that's when I'm buying it. And as you can see, the difference between this and this and this, okay, is right now 10%, for example, for Microsoft. So according to my calculation here and the research that I've done, Microsoft is undervalued 10% at the moment, okay? And that gives me an opportunity to add to that stock. Then I've got KLA, another tech company. Then I've got Salesforce. Look at Salesforce, right? 21% down. My price target is 272. Right now it's $213 per share, right? So definitely will be adding to this. I'm not selling it. CrowdStrike is, I call it speculative tech. I don't think I would be adding to it yet because I want to give myself a little bit of margin of safety. I think I put it down 10%, but I think I might go for 15-20% margin of safety. So if I did that, so if I change that to 15%, if you're interested, this I've done a video on this before. I've shared with the community as well, so you can take that and just change as much as you want. So as you can see, I've changed this to 15% now, so it's still 5%, 8% down. So I might actually add to it. Then you've got Medtronic, Merck, Amgen, you've got J&J. All of these healthcare companies are undervalued. Now, what I love about the tech and the healthcare are basically the two sectors that are very like growth-oriented kind of sectors, because healthcare, obviously, for health reasons, they are always coming up with the new products and so on. And I like the technology companies. So I normally tend to buy more of these sectors, but obviously I love the industrial sector. So I've got 3M, I've got Cummins, for example, and then I've got VF Corporations for cyclicals. Lowe's and Home Depot, I haven't actually purchased anything for a long time, but Lowe's looks like now is coming back to a fair valued. Now I think it's down almost to 10% or something like that. There we go. Lowe's companies is actually down almost 11.5% since beginning of the year, which is very, very good for me, because at one point it was $260 per share. So right now it's actually coming down. So again, that's one of the reasons I'm thinking of adding to this stock. Then you've got Home Depot. Okay, Home Depot, I'm not touching it yet. I'm waiting for maybe another 10% down. So then you've got Procter & Gamble. Procter & Gamble is one of those businesses that really overvalued at the moment. They had a great quarter. Okay, the earnings report just came out. It's amazing. But again, I don't think I will be adding to it for quite some time. UPS, SPGI, and the Moody's, 3 of these companies have not added to my portfolio yet. These 2 used to be there, but it was a fractional shares. They were overvalued. They still are. I'm going to wait for maybe a 10-20% drop. It could happen. Okay, so far, as you can see, for example, companies like Lowe's, a couple of months ago, you wouldn't think Lowe's will drop 10%, but it has. And these things do happen. You give yourself a chance. If there's a company that you really genuinely like and you feel like it's, you want to add to your portfolio and it's 20%, 30% overvalued, don't buy it. Wait until you have a buying opportunity. Okay, so I don't want to make this video long, but I just want to let you know, if these stocks, I'm definitely going to be nippling, just adding a little bit here and there. But if it carries on dropping 10%, whatever, I know Microsoft is not going anywhere. I know for companies like Salesforce or Merck, for example, or Johnson & Johnson, 3M, they're not going anywhere. They're still going to be around for a very long time. Okay, they might have a couple of years where things are not working out. But again, that's the beauty about dividends paying companies. Like 3M, for example, if they don't have a great year, that's absolutely fine. They have actually had a terrible year last year where they have actually not grown at all. In fact, I'm going to show you very quickly, okay, because it was one of the stocks in my portfolio that was actually down almost the whole year. So if you look at it, almost 10% down a year, and then year to date is almost 5% down. So it hasn't done anything in my portfolio. In fact, I think it's a negative right now. There we go. It is a negative right now. Okay, but you know what? I'm not really worried about that, because what I'm going to do is I'm going to buy more of this stock, because I know the dividends will be there, and then I can use that dividends to buy more shares of this business and hold on to it. And guess what? A couple of months down the line, it will come back and it will be fine. It might take a year, it might take 2 years, but I know the business is not going away. So you really need to have that sort of a conviction. You need to be able to say to yourself, I actually believe the business model. I know where it's heading, and I'm going to buy it and I'm going to add to it. So don't listen to the news. InshaAllah khair. We'll see whatever happens. But most importantly is do your research, please. Find out about these companies that you own. If there's a company in there, just like the Intels and the Cisco's, and you believe they're not going to come back, you're better off basically doing what's called the opportunity cost. Okay, take that money, put it into another company that you really believe that's going to give you a better return in the long run. You're better off doing that than just waiting for 20 years and still not being able to break even. I hope you enjoyed the video. Assalamu alaikum. Take care.